chapters 12, 13, and 14 lecture. This is our final lecture for the semester. Let's go over corporations. This chapter goes over the accounting for corporations. Before we do any accounting though, let's examine the characteristics of a corporation. Firstly, corporations are a separate legal entity, meaning they're separate from their owners. The ownership is evidenced by the sale of stock or those having stock. So if you have a stock for a corporation, you are considered an owner. Ownership is easily transferable. So again, let's assume you're an owner of a company because you own a share of stock. You can easily get rid of your ownership by just selling your stock back to the market. So that's why it is easily transferable. There is limited liability, meaning if you're an owner and your big corporation that you own gets sued and they lose, none of your personal assets will be affected. There is a board of directors. The board of directors makes the important decisions for a corporation, and they are usually nominated by common stockholders. It's a separate taxable entity, meaning if the corporation you own makes millions of dollars and they get taxed on those millions of dollars, the corporation gets taxed and not you. Earnings are distributed through dividends, meaning if the corporation makes enough money and has really good cash flow, the board of directors may decide to give some of that back to the shareholders in the form of either cash dividends or stock dividends. Next, we're going to go over organization costs, meaning what does it take to incorporate? Let's assume that the corporation is a big one and they want to become a public corporation. And this is when organization costs come in. There may be legal costs, or there will be legal costs. You'll have to pay taxes. There's a state incorporation fee. And taxes, once again, for that state. There'll be licensing fees. Promotional costs, because when you go public, you need to make sure you promote your corporation or your company. So when it goes public, there are buyers or investors ready to invest in your stock or the sale of your stock. That's a very short list, but each one is very expensive and will cost the corporation a lot of money to be able to go public, issue their stock, and attain a large sum of money from the sale of the stock. Accounting wise, for organization costs, it's pretty easy. All you have to do is add all the organization costs and journalize. In other words, if we look at that previous list we just compiled, you do not have to record every single line item as one item when the company incorporates. Add all the costs up and debit one account, and that one account is organization expense for a certain large sum of money, and then you're going to credit cash. And there you have it. That is the simple journal entry, or a very simple journal entry to incorporate as a corporation. So costs for incorporation. As stated previously, this is an introduction lecture. There are specific videos for each topic, and on this slide there's actually two videos that stem from it. One is journal entries for stock, and the other one is how we distribute dividends. So I'm going to put those YouTube logos right there to remind you. Next, we're going to go over the stockholders' equity section. If you recall, revenue minus expense is your income statement. Then you take your net income and loss and you combine it on the statement of retained earnings, or you subtract dividends. And after that, you'll get your ending retained earnings, and that ending retained earnings gets transferred over to the balance sheet, which makes up the accounting equation. What I circled just right now is the plus C minus D plus R minus E. That is your stockholders' equity. What you see on the slide is your expanded accounting equation, where the stockholders' equity is expanded into 4 different components. Again, that's capital stock, dividends, revenue, and expense. Assume you are a company. What are the different ways to attain cash? In reality, there are 3 different ways to attain cash. The first way is to earn it. And the way that you earn it is when you provide your goods and services to customers. As soon as you do that, hopefully they pay you, and there you have cash. So earn it. The second way is borrow, which was our previous chapters, notes payable or bonds. So again, notes and bonds. The difference between the two is you take the note out at the bank, for example, and bonds are money lent to you from investors. And the third way is given. So you're given it. You're given cash. And who would give a corporation cash, a company cash? Well, investors will. The company just needs to issue stocks, and in return they will get money. So earn it is actually revenue in the expanded accounting equation. Borrow is under liability. And given is the capital stock. Because again, you issue the stock, you the company, and investors will give you money. There are 2 sources of owner's equity. And owner's equity, just as a reminder, also means stockholders' equity. So 2 sources of owner's equity or 2 sources of stockholders' equity. Before we go into that, let me remind you of the accounting equation, the condensed version. It's your assets equals liabilities plus stockholders' equity. And as you saw up top, stockholders' equity can be broken out into 4 different components. But when you're looking at the balance sheet, which is the accounting equation, the stockholders' equity section has 2 sources or 2 sections. The first section is the retained earnings. So retained earnings. This balance right here is coming from your retained earnings statement. And in reality, retained earnings is your earnings minus your dividends. The second source or second section of the stockholders' equity section on the balance sheet is under paid-in capital. Paid-in capital is what's given by the owners. And there you have it, retained earnings and paid-in capital. One is how the business did minus the dividends. And the second one is what the investors gave in respect to money in exchange for stock and ownership. Next, let's go over stocks themselves to get you familiar with what stocks are. Before we do, let's talk about outstanding stock. Now, this term can get a little confusing, so we're going to go over terms related to the term outstanding stock. First of all, there's a term or a phrase called authorized shares. Shares is another word for stock. Authorized shares are the amount of stock to be sold. And that's usually determined by the board of directors. They'll authorize a certain number of shares to be sold in the future. Now, do all those shares get sold? No. It's just a total amount that is allowed to be sold by the company or issued. Next, issued shares. So issued shares is the amount of stock actually sold into the market. So when they issue the shares, they get money in return, the company does. Next, we have outstanding shares. Outstanding shares is the shares in the market. Now, you may think that issued shares and outstanding shares equal the same amount, and sometimes they do, but not in all cases, because there is a stock or a type of stock called treasury stock. These are shares bought back by the company. So you could have issued shares equal outstanding shares, but as soon as the company buys back some of that stock, then the issued shares and outstanding shares will not equal one another. Because again, the company just bought back stock, and that stock they're buying back is now considered treasury stock. There's a formula, and it's the following. So issued shares minus treasury stock equals your outstanding shares. So you take what was issued, you subtract what was bought back, which is treasury stock, and you will get your outstanding shares amount. Let's quickly talk about par value. When you go over the textbook problems, there's a lot of this term on each stock transaction. So really, par value is just an arbitrary amount assigned to the stock. So arbitrary amount assigned to stock. In reality, it represents the legal capital that the company cannot give back to the investors. What I'm saying is, let's say investors give a company money by buying stock. The company cannot turn around and give that investor back all that money or more. It's called legal capital because it protects creditors. Creditors are who the company owes interest and principal amounts to. It protects them from the company giving too much money back to the shareholders. Now, there are two characteristics of stocks. One is called common stock and one is preferred stock. Let's talk about the most common, which is common stock. This is what is normally purchased when you go to the internet and you want to buy stock. Let's assume you are purchasing common stock. When you purchase common stock, each investor gets one vote for corporate matters. For example, if you wanted to vote who was going to be on the board of directors and you have one share of stock, then you get one vote. So investor gets one vote per share, and that's for the board of directors. Next, we're going to talk about preferred stock. A company can issue one or the other or both. Usually it's common stock. But if a company was to issue preferred stock as well, let's go over what types of preferred stock we have. So there's different types of preferred stock. What I'm going to do here is compare the different types. Before we do, in general, preferred stock receives dividends. Remember, dividends are payments back to the investors. So preferred stock shareholders, they receive their dividends before common stock shareholders. And if there's anything left over, then it goes to common stock. Let's say the board of directors declares dividends. Again, it first goes to preferred stock, and if there's anything left over, it goes to the common stock shareholders. As I was saying earlier, there are different types of preferred stock. I'm going to go over this by comparing. So One is cumulative preferred stock, and the other one is non-cumulative preferred stock. Cumulative means that the shareholder has the right to receive dividends that are owed. What are dividends that are owed? It's dividends that were previously declared in previous years, but the company did not have enough money to pay them out. So the company declares it as arrears, and in the future, the cumulative preferred stockholders will get that money. So this is referred to as arrears, ARREARS. Anything owed that was previously declared in the past. Of course, you'd want cumulative versus non-cumulative, because if it was non-cumulative, it doesn't matter what the company declared in the past, you don't get it for the current year if you're non-cumulative preferred stock. Next, let's go over participating preferred stock and non-participating preferred stock. Now, participating preferred stock is the best out of the two because when the company has extra money, it can choose to give it to the participating preferred stock shareholder. So it gets money depending on the company's performance. In essence, if you're the participating preferred stock shareholder, you get an extra return on your investment. These days, the participating preferred stock shareholders, they don't really issue a lot of that type of preferred stock because again, it's dependent on the company's performance. It's mostly non-participating. So let's combine these types because there is a combination of the two when you kind of say the preferred stock type. So as an example, again, these are the most common ones. I'm going to write two of them. The first one is cumulative, non-participating, preferred stock. And that would be a type of preferred stock, a cumulative, non-participating preferred stock. Or a non-cumulative, non-participating preferred stock. And those are your types of preferred stocks. Yes, there could be participating as well. So you have different combinations depending on the corporation issuing the preferred stock. When you go to view the separate videos, please check out the distribution of dividends between the preferred stock and common stock shareholders. The next topic we're going to go over is the statement of cash flows. There's a whole chapter dedicated on this final financial statement that we have not talked over or gone over, and that's on chapter 13. So what is the statement of cash flows? Why is it so important? Why is it that there is one whole chapter dedicated to this financial statement? Well, it gets rid of accrual accounting. Accrual accounting, if you recall from the early chapters, is how revenues and expenses are recorded. More specifically, how we record revenues and how we record expense. We record revenues when we provide our goods and services, we as meaning the company, and we record an expense when they happen. And in reality, it doesn't matter when we receive cash or pay cash out, and that's what accrual accounting is. Now, the statement of cash flows wants to get rid of this. Or in order to restate transactions to cash only, or just cash basis. This is very important because if financial readers want to know a company's true cash flow, they could just look at the statement of cash flows. Now, in the statement of cash flows, there are three sections. The first section is called operating activities. Now, operating activities deals with cash from customers, and it deals with cash being paid out to vendors and suppliers. So cash from customers, and then cash to vendors and suppliers because those are the folks that the company will pay. And it also includes employees because under normal operating under normal operations, you have to pay your employees, assuming you, the company, has employees. The second section is called investing activities. Under investing activities, it lists cash for fixed assets, meaning it will list any cash dealing with fixed assets. It also deals with equity and or debt securities of other companies. This is other companies, meaning let's say you're the company and you the company invest in other companies by buying their stock or uh, letting them borrow money through bonds. So that is called investing activities, or it's under investing activities. The last section of the statement of cash flows is called financing activities. Now, this is the equity and or debt securities of you, the company, not of other companies, but of you, the company. This is your own stocks. This is your own bonds. And that's called financing activities. Another way to remember it is if you want to finance something, you're either going to be given money or you're going to borrow money. And how do you do that? Well, you issue stocks or sell stocks, or you issue bonds to try to finance something. Now, there are two methods to create the statement of cash flows. One method is called the direct method, and we're not going to go over that too much. The second method is called the indirect method. And that I created a whole video dedicated to the indirect method, and that's what you will be responsible for this class. So the indirect method, let's go over an example of a statement of cash flows. This right here is the outline for the statement of cash flows. It starts with operating, then gets into investing, then financing. One important key to note here is under the operating activity section, you always start off with net income. Net income, if you remember, is from the income statement, and the income statement is filled with revenues and expense accounts. So you got to start off with that because that is the amount we're trying to adjust, or we're trying to get to cash basis. And there it is, operating, investing, financing. There's a change in cash, and then you look at the beginning cash, and then you have a final ending cash. So let's first talk about the operating activity section. Again, that's the very first section. Here's an example from the textbook, from an older textbook actually. This is cash from operating activities, and you always start out with the net income. You pull that amount from the income statement. And here it is. These are your operating activities. And as soon as you get that in order, you add and deduct. So this is operating activities. And if you see that $115,000 or $115,120, that is your total operating. The next section is your investing activities. And the net for the investing activities in this example is a negative $40,000. Next, we have our financing activities. And as soon as you do that, you net an amount of negative $30,670. So there you have three amounts from the operating, investing, and financing. You're going to combine those three amounts, and you're going to get $44,450. You're going to combine that from the beginning year's balance from the cash account. And as soon as you do that, you should end up with the cash balance at the end of the year, which is $140,350 for this example. Just to note that you have the beginning cash balance and you have the ending cash balance from the balance sheet. or balance sheets from the current and previous year. And the statement of cash flows tries to tell you in detail, well, why did it change? It changed $44,450. So where did that change come from? And really, it comes from operating, investing, and financing. So really, the statement of cash flows is a breakdown of that $44,450. All right, videos and attachments, or the other videos for these chapters. So review all the YouTube videos posted with lectures. So these videos include journal entries for stocks, overview of distribution of dividends, the statement of cash flows using the indirect method. There's videos on horizontal analysis and vertical analysis. Those two are not my videos, but the creators did a good job explaining things. And finally, review attachment for the financial statement analysis. It's for the very last chapter.